In this video, we're going to talk about business forms, right? When we create a business, what is the form of that business? Talk a little bit about taxes. And then in later videos, we're going to talk a little bit about the principal agency relationship and how that relates to business forms. So if we think about the different kinds of forms, there are three basic forms. The first one is sole proprietorship. Only one person owns the business. Now, one of the key factors or characteristics, if you will, is that in a sole proprietorship and also in a partnership, the owners have what's referred to as unlimited liability. So if an owner gets sued and they lose the lawsuit, where does the money come from to pay the penalty? And the answer depends on business assets. For sole proprietors and partnerships, a person's personal assets are included in their business assets. So in other words, the business itself is not seen as being separate from the individual. So if you get sued, especially if maybe you have a business that's been in place for a while, they probably don't want the old assets. They want the toys and the other assets that you've been able to accumulate over time. So unlimited liability puts your personal assets at risk. For a partnership, again, there's just more than two people. Typically, there should be a contract that's written that formally establishes the partnership and the rules. And corporations are legal business entities. Essentially, they have all the rights that individuals have, except they don't have the right to vote. Now, with a corporation, the owners are referred to as stockholders. Of course, we know that. But a corporation also has limited liability. So what that means is corporations then are legal business entities. And they can do just about anything that you and I can do except vote. Owners are referred to as stockholders. They obviously purchase a share of stock, and that's what represents their ownership. But corporations have what's referred to as limited liability. What this means, relative to when we talked about the partnerships, is that in this case, the only thing a shareholder can lose is the price they paid for their stock. So if you paid $50 for a stock and that company went out of business, went to zero, right? The stock price is now worth zero. If the company still owed money, the company can't come to you and ask you for more money to cover the debts of the company. So the most you can lose is the amount that you invest. We've talked about this again. Stock obviously represents the ownership. Dividends are the periodic distributions. There's a board of directors that essentially oversees the entire company. They're primarily involved in a couple of things. Number one, approving the strategic goals and plans, setting some general policies, but although it doesn't mention here, they are also in charge of determining the dividends to be paid. There is a president or a CEO, somebody that oversees the entire operations. Now, below that CEO, there are other officers, right? There's a chief financial officer. There could be a technical officer, a marketing officer. All of these are different levels of management within the company. Now, when you think about taxation, right, the tax code has changed dramatically since 2018. Prior to 2018, partnerships and proprietorships, you paid in as an individual taxpayer. Corporations were also taxed but it was a mostly progressive rate structure. That is, there was a table of brackets that you would assess how much you earned in profits and then calculate the tax from. There are two kinds of tax rates, and we'll talk about this again in a second, but the marginal tax rate represents the tax on the very next dollar that you earn. The average tax, that equals the taxes paid divided by taxable income. So the marginal tax rate, when you think about making decisions, decisions are all about the future. So the marginal tax rate refers to taxes on future dollars. That's the tax rate that we should use in decision making. After 2018, again, proprietorships and partnerships are still taxed on a rate structure similar to before, but it's slightly revised. Corporations are now taxed at a flat rate of 21%. So under 21%, the marginal and average tax rates are now equal. They're the same. What we have when you think about corporations, though, is we have a system of taxation that creates a weird circumstance, and that is it's referred to as double taxation. When corporations make profits, they pay taxes on the profits. Now, when they distribute those profits as dividends to shareholders, shareholders again calculate taxes. So that some dollars of profit are taxed twice in a corporation. Just like individuals, corporations also have ordinary income and capital gains income. Again, the actual tax rates can change over time. Right now, they're very close, very similar, but ordinary income comes from running the business, but capital gains comes from selling the assets of the business. So if you think about choosing a company, what form would be best for you, right? How would you best choose how to create this business that you want to start? So let's think about this. Well, if you want to start a business, the first thing you have to decide is what business you want to be in. Then you need to decide how are you going to run that business. You're going to run it with lots of capital equipment, or you're going to run it with lots of variable assets or variable costs. But there are four characteristics that really drive the form of the business. That is, sole proprietorships, partnerships, or corporations. So if you're concerned about taxes, how does that affect you? We know that sole proprietors and partnerships pay at the individual tax rate structure. We know that corporations pay taxes. We know that it's a flat rate right now, but we also know that owners also pay taxes. So there's double taxation if you create a corporation. When we think about risk, we know that if a business is sued, where are they going to get the assets to pay for losses? We talked about the difference between unlimited and limited liability. So if you're a corporation and you have a very risky business, you want to be a corporation because then the potential losses are less. What if you want to expand your business and grow? Sole proprietorships and partnerships are pretty difficult to raise large sums of money. I mean, you can gather money. You can certainly try to reinvest profits, although for most small businesses, there's not a lot of profit to reinvest. But in the end, if you want to grow, you're going to have to be a corporation to do that because you have access to more investors. And in the end, just a different kind of a circumstance is control, right? Why do entrepreneurs want to run their own business? It's because they want to be in control. They don't want to answer to anybody else. So who runs the company? Most entrepreneurs do not want to share the company, right? They don't want to share control of the business itself. So if you don't want to share the business, then you need to be a sole proprietor, right? Why would you need more owners though, right? Why would you want to split control? Well, maybe it's for cash, for expansion, etc. But on the other hand, maybe it's to get some complementary skills. If you're a car mechanic, right, you're really good at making cars, but you're not really so good at marketing or finance. So you may want to have a partner that's the business partner, right? Because their skills will complement your skills. So let's again continue talking a little bit about taxes, right? We've already mentioned the idea of double taxation. We know what that means. Corporations do get a bit of a break on dividend income, though. Corporations typically pay taxes on 30% of the dividend that they receive. Now, it sounds like a good deal for them, right? They get to write off 70%. But remember, the dividend income is profit from another company, and that money has now been taxed twice. So in order to kind of get away from triple taxation and have that trickle down through the corporations to the eventual owners, they get this little deal. We mentioned the average tax rate. Here's the formula. It's just the tax liability divided by taxable income. Now, this really isn't a good thing for decision making because it looks at the average over all the dollars and it looks at historical kinds of profits. Marginal tax rate is the tax on the next dollar earned. That's what we want to use for decision making because it measures future profits. Let's see how we can calculate taxes. So this is from 2018. Now the process changes from time to time, but in general, this is how we calculate taxes. Once you find out what your taxable income is, right? Earnings before taxes, you find that in these brackets. And then you follow this formula. So if you make $200,000, what is your tax? It's $45,690 plus 35% of any amount over $200,000, which is zero. So this would be your tax. What if you made $300,000? $45,690 plus, again, 300 minus 200, that's 100,000 times 35%. That's another $35,000. When you add that to this, you end up with $80,690. And you do the same thing. This is, again, pre-corporate tax rate, but that's how you calculate tax here, right? If you made $11 million, you would pay $3.4 million plus 35% over of $1 million. Again, another $350,000. So the total tax, $3,750,000. So let's show an example here, show how this works. Now again, some of this has changed post 2018, but it's kind of important to understand how you calculate this because we never know what the legislature, what is the federal government going to do to the tax code. So here we have Daniel Webster, right? He made $150,000. He has no other income. What are the taxes he's going to have to pay based on this 2018 tax code? So again, it's $150,000. So we go to the personal code, right? It's $150,000. It's in this row. So it's $14,090 plus 24% of what's left over, $82,500. So here's this number, $82,500, $30,290. So the average tax rate is 20%, but the marginal tax rate's 24%. So you see, if you use the average tax rate to predict business, let's say we think we're going to do another $10,000 in income. What's the tax rate on that next $10,000? It's not 20%, it's 24%. So marginal tax rate is what we use. In addition, if you wanted to think about a corporation, again, this is pre-2018, 150,000 is right here, 22,250 plus 39% of 50,000. So again, our tax is 41,750. Again, it's a little bit higher. 27.83 is the average, and the marginal tax rate's 39%. A big difference between average and marginal, especially with this pre-2018 tax. Now again, remember that the current tax code for corporations, average tax rate and marginal tax rate are the same because it is a flat tax. So prior to 2018, how this would work was in the beginning, the marginal tax rate is higher than the average tax, but eventually, if you make enough money, these two lines become one. So eventually, the marginal tax rate becomes the average tax rate. So typically, when we talk about taxes in our videos, in our problems, we're typically going to use just a number, right? So we'll typically use 40%. Why 40%? Because it's easy to multiply by. In the older code, you saw that taxes could be as high as 39%, but on the margin at the top, it's 35%. So 35%, then you add an average of 5% for state taxes, we get 40% is how we use the tax code there. So let's continue. Again, we talked about ordinary income, capital gains income. It's very important for you to understand the difference between the two. Especially for individuals, there's a difference between ordinary income tax rates and capital gains tax rates. But for businesses, again, everything is a flat tax. What about the taxation of income? Interest that's received by corporations. So if a corporation buys a bond of another company and they receive interest, they're going to pay taxes on that. The tax they pay is obviously that 21% rate. Now, if they receive dividends, again, we've already mentioned that's a special tax break that they get. Again, this is a revised slide. So you see now that it's 50% is the exclusion. So it's not the 30% where they get 50%. And again, what that does is it gets rid of some of the double taxation issue, right? So again, in calculating taxes, corporations deduct operating expenses as well as interest expenses. But dividends are not tax deductible to the corporation. One thing just to add is other forms of business, right? There's limited partnerships, S corps, LLCs, LLPs. There's MLPs. There's other kinds of business forms, if you will. All of these have characteristics that are combinations of the three primary ones. So they're all relatively related one way or another. Most of the things that are different have to do with taxation and risk. So I hope you liked that video. I look forward to talking to you next time.